This is the fourth and final video for London. Please pause the video when I step off screen, copy the materials down in your notes, leave some spaces to add some comments in, and then press play and I'll talk through it. Okay, in this video, we're going to talk about insurance companies, how they're owned, some roles within them, and the products they offer, right? So first off, insurance company ownership structure. There's three main types. You could be a publicly traded company. So this would be called a stock insurance company. It's owned by the people who purchase stock in that company. These people are called shareholders, right? Now, Travelers is an example, and I can purchase stock from Travelers from the stock exchange, phone up whatever your financial broker and say, hey, purchase 10 shares of Travelers insurance, and now you're a part owner of Travelers. I don't have to have my insurance through Travelers at all to be a part owner of Travelers. Okay. The other kind, main kind, is a mutual insurance company. This is not a publicly traded company, so you cannot go buy stock in this company. The owners of the company are anyone who's purchased an insurance policy with that company. So the policy holders are the owners of the insurance company. And there are rules to figure out how these policy holders unite to create a board that governs the insurance company. So Mutual of Omaha is perhaps the most likely name you've heard of that is like this. Locally, there's a company called SFM that provides workers' compensation insurance. They're the largest provider of that in Minnesota. And the M in SFM stands for mutual. Okay? There's also a variety of other ways of other ownership structures. One that I'll mention, and hopefully one or two of you might do an article on this, is called captive insurance companies. So a captive insurance company is an insurance company that is created and owned by a different company. So for example, 3M, a large corporation, they have a lot of insurance needs. They might decide they're going to retain a bunch of risks. They could create a captive insurance company that exists solely to sell 3M insurance and to process claims that 3M will have on those insurance policies. It sounds very circular. 3M is going to create this insurance company. It's going to pay them premium. And when 3M has a loss, it's going to collect losses from that insurance company. It sounds just like, well, 3M has simply retained those losses. Why bother creating this insurance company? The long and the short of it is there's some really good tax implications for a company by forming a captive insurer to serve many of their insurance needs. Hopefully, one or two of you might do an article on the captive insurance company, and we can talk about that a bit more fully. Okay? These have really come into the forefront in the last couple of decades. All right, so within an insurance company, if you're looking for roles within an insurance company, there's hundreds. Here are some of the main ones. One role is you could be the person who sort of sets the guidelines for how you price an insurance policy being offered by the company and determines how much of the premiums that you collect need to be reserved for future claim payout. It's called reserving. This is the role of the actuary. They don't actually determine the price of anyone's policy. They simply create these guidelines for how a policy should be priced. Okay, well, so who does set that price? Well, another role is you could be the person who either accepts a customer who wants to buy insurance from you or rejects them. And if you accept them, you would be the person who would then determine how much premium you're going to charge them. Okay, this is the role of the underwriter. And this word underwriter comes directly from Lloyd's of London practice, which we'll learn more about where that strange term came from. So the underwriter receives the guidelines from the actuary and then uses those guidelines to decide what the actual premium for a customer that they're willing to accept is. The underwriter might look at a customer and say, oh my gosh, you've been in 8 accidents in the last 2 months. No, I'm not even going to give you a price. I'm simply going to say, we do not want you as a customer. Okay, so the underwriter decides what are good risks for the insurance company to accept and how much to charge for them. All right. Well, somebody's also got to bring those customers to your door, right? So someone's got to sell for you. So there's a lot of ways insurance companies sell policies, solicit customers, basically. You can go online for auto insurance and homeowners. You can go online and do it directly through the internet, right? So it could be an automated process by which insurance policies are sold, okay? And in these automated ones, there's probably no human underwriter actually looking at the information you provide before a price is sent to you. Because auto and homeowners, these are very standardized things with millions of people purchasing them, and enough of us look enough alike in terms of our risk profile that we don't need an actual human to price these things out. Okay, but a whole lot of insurance policies are far more complicated, especially the business insurance ones. Those require the underwriter. Okay, so with sales, some insurance can be sold automatically through internet, right? Others use agents. An insurance company might have some agents out there who go selling the insurance policies to different, individuals or companies. So a lot of small business insurance policies are placed by agents. Okay. Well, there's also a role called a broker. Oh, going back to agents. Some agents will only work for one insurance company, like your State Farm agent, Jake from State Farm. Other agents will be able to sell insurance for a variety of different companies. Okay, so there's either a captive agent or an independent agent. So there's a lot of nuances here. Brokers are people who work with larger companies who have more complex insurance needs. And the broker's job is to talk to the client, this larger company, and say, oh, okay, I see all the insurance needs you feel you need. The broker's job is to then go and shop that company's insurance needs out to a bunch of different insurance companies and create an insurance package for that large company seeking to fulfill their insurance needs. The broker might say, all right, your workers' comp, we feel the best deal is through Travelers. Your officers and directors liability insurance, we feel you should go through Chubb for that. So the broker is there to act as the middle individual who connects the company who has all these diverse insurance needs with the multitude of insurance companies that are making bids on how much they're going to charge to satisfy some of these insurance needs. The broker pulls it all together. Okay. Twin Cities has a ton of all of these people, right? I mean, honestly, the insurance industry is such a great industry to think of going into. If you love talking to people, agent, broker. If you love, okay, sorry, shut up, so keep talking. Okay, the fourth role. Insurance companies need to pay out when there's a loss, okay? So another role is to receive claims as they come in. So a customer says, hey, I have an insurance policy with you. I've suffered a loss. Give me my money, right? So claims individuals handle these. They receive those claims. They verify that the loss that's been experienced occurs, so no fraud, and that it's a covered loss. It's a loss the insurance policy has agreed to pay out on. The claims individuals determine what the loss amount is. They might have help with this, help from someone called an adjuster to say, oh, that fender bender, okay, that's a $3,200 claim. Okay, and then they pay the loss if it's covered, right? So that's claims. And there's huge need for these individuals as well. And then the final big role is insurance companies need investors. Insurance companies make their money in two ways. One, they might collect more premiums than they pay out in claims and expenses. But please note, premiums are regulated by the state in a lot of different cases. So insurance companies just can't jack these premiums up, and make a ton of money. I mean, clients might leave them because it's too expensive, and the state might say, no, at that price, you don't get to sell in our state, okay? So keep in mind, insurance is incredibly regulated by the state, right? And we'll talk about that in London. But if the actuary and the underwriters do their jobs right, the insurance company might take in a bit more in premium, maybe 5% more in premium than they're paying out in claims and expenses, salaries, rent for the building the insurance company's in, blah, 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 okay? The other way insurance companies make their money is when the premium comes in, they invest it. And there's this period of time called the float between when the premium comes in and when that individual has to have a claim paid out, or when the claims get paid out. So there's this float period that you invest in. Now, some float periods are a lot longer than others. If you're a life insurance company, you start collecting premium from somebody when they're in their 20s, and you don't have to pay out until they die, let's hope, in their 80s or their 90s. So you've got decades of float to invest money in. If you're an auto insurance company, your float period is much shorter, all right? And that impacts your investment style, basically. So anyway, insurance companies need investors, right? Oftentimes actuaries start to fill this role, but they're looking for anyone who's really good at investment can get into this field. If you're a finance major, am I talking to Will? If you're a finance major, you want to invest money? Who's got money? Banks have some money. Insurance companies have a lot of money to invest. So go work for an insurance company. Okay. Finally, what are some types of insurance companies based on the products offered? In the United States, these are sort of the big three categories. It's slightly artificial, okay, which I'll slightly explain. First big category, probably the biggest category, is you have life and health insurance companies. So life insurance companies, Allianz Field, they must have some money to sponsor an athletics field. Allianz Field, Allianz is a life insurance company. They sell life insurance policies and retirement products called annuities. You have health insurance companies. Gosh, why am I blanking? UHC, United Healthcare. You have health insurance companies that provide health insurance or help administer health insurance, right? Life and health insurance companies on the actuarial side of things are served by the Society of Actuaries, the SOA, this remnant of medieval guilds, which were benevolent societies from the 2,500 years ago. Okay? Society of Actuaries helps serve the actuaries who work in life and health insurance. And that's about 70% of US actuaries. The other big category is property and casualty insurance, P&C. So anything that's not life and health, it's P&C. So auto, homeowners, all kinds of business insurance. Businesses have myriad of insurance needs. Things like cyber insurance, professional liability, medical malpractice insurance, that's P&C. So there's all these host of other kinds of insurance products that aren't life and health, and that's property and casualty. They're served by the Casualty Actuarial Society, or the CAS. Okay, and they're approximately 30% of US actuaries. The United States is the only nation in the world that has two different actuarial societies. So that's why this split is slightly artificial. I wish we only had one. It would make my educational job of educating actuaries much easier, but we don't. All right, the other third category, the third main type of insurance company based on product is a reinsurance company. So think Swiss Re, Swiss Reinsurance, Tiger Re, which is becoming bigger and bigger in Minneapolis, Tiger Reinsurance. Okay, so reinsurance companies are companies that provide insurance to insurance companies. Insurance companies are taking on a bunch of risks in exchange for premium. They might want to cover themselves in case those risks, too many of them come in at once and make claims. So they might purchase an insurance policy with a reinsurance company to help them in the event that they have more losses than they expect. Okay. There's also some other reasons for purchasing reinsurance that we'll get into, but reinsurance is another amazingly wonderful kind of company to work for. Very global in nature. And so, you know, you can think of insurance as spreading risk out more and more evenly. I don't want to carry all of my risk of driving a car on myself. I don't want to retain that. In fact, legally, I'm not allowed to. But anyway, I don't want to retain all that risk, so I purchase insurance. Insurance companies don't want to retain all the risks they have taken on themselves, so they purchase reinsurance. What does a reinsurance company do? Do you think they purchase insurance to cover all the reinsurance that they have issued or written to insurance companies? You bet they do. So we try and diversify this risk to more and more and more layers so that there's more even coverage. It becomes a very global endeavor. All right, so that's the end of the videos. Some of this is overlap with the AM Best 70-page guide that you're also reading, but hopefully this provides a bit more. Remember, please bring these notes to London. All right, they will be very helpful there.